Hey, Sammy, thanks so much for your question about rebalancing a portfolio. It's a really good question, and one that I've just written about in terms of asset allocation and whether you should be comfortable with what would be regarded as an unbalanced asset allocation. And the theme behind my blog was that, yes, I think at times you should be comfortable with something that's not perfectly balanced, particularly if you're overexposed to markets that you feel are undervalued and therefore will enjoy some mean reversion at some point. There's a couple of things to think about. The first thing is that if we find that a portfolio is overexposed, so let's say that we invest in the US market 10, 15 years ago, it's enjoyed pretty stellar returns. I'm talking about the S&P 500, pretty stellar returns over the last period of time. And now the portfolio is overexposed, or we feel it's overexposed to the US market. In that situation, we've got two options. We could sell down US and reallocate that exposure elsewhere, or we could use new monies to dilute the US. And what we're always trying to do is reduce portfolio turnover. And that really should be your aim. You should try and avoid buying and selling wherever possible, because obviously you've got transactional costs, buy, sell premiums and so forth, brokerage. But then most importantly, you've got taxation consequences associated with that as well. And so we're always trying to minimize them, and we would prefer to use new monies to rebalance a portfolio rather than sell down existing investments. But if you get to a point where your portfolio is so overexposed to one particular sector, geographical market, or stock, it might be important to gradually sell down that exposure and reinvest elsewhere. And mathematically, if you go back and backtest rebalancing every 12 months, mathematically, it will maximize your returns. And most importantly, it will reduce the portfolio's volatility. So yes, it's important, but try to use new money to rebalance a portfolio rather than selling down existing investments, and try to minimize portfolio turnover as much as possible. You don't have to be accurate down to the 0.1% in terms of allocation within that portfolio. To my mind, you can stomach something that's relatively unbalanced depending on the risk profile and future expected returns. But reweighting or rebalancing a portfolio is actually a very important thing to do over time, or from time to time, and both mathematically and historically in terms of backtesting is proven the best way to reduce portfolio risk and maximize returns. Great question, however, and thanks for asking it. Cheers.